Welcome to 3 and 3. Today we're going to be talking about debt ceiling, earnings, and quality stocks. So debt ceiling. So the U.S. national debt has soared to $31.8 trillion, and the U.S. has had to borrow more money to pay for government spending increases. This borrowing is known as the debt ceiling. When the U.S. spends the maximum amount authorized under the ceiling, Congress must vote to suspend or raise the borrowing. Since 1917, when it was first introduced, the debt ceiling has been raised over 100 times. The debt debate usually occurs when one party doesn't have control of both the White House and Congress. If Congress cannot reach an agreement on raising the ceiling, the U.S. could default on its debt. So what we're looking at here is a chart of the U.S. debt to GDP. And you can see the dramatic spike in debt during the 2008 and 2009 crisis, and also during COVID, during 2020 and 2021. We currently stand at 130% debt to GDP. Although that doesn't cause a problem today, that potentially could cause issues in the future if our interest rates continue to rise and the interest we're paying on the debt becomes a larger percentage of our actual spending per year. Earnings. When corporate earnings rise, the stock market tends to rise as well. Investors are willing to pay higher prices for stocks when they believe that companies are making more money. In the first quarter of 2023, earnings actually surprised to the upside. 78% of S&P companies beat on the actual reported earnings per share, and 58% actually beat on revenue. So many things come into play when we talk about earnings. Economic growth, inflation, interest rates, and sentiment all play factors when it comes to how well a company reports during the current economic environment. So what you're looking at here is a chart of the stock market and earnings. And you can see the high correlation between earnings going up and the stock market actually going up with it, and also the vice versa. So if you go back to the Great Recession, you can see that earnings per share peaked and the stock market actually followed the decline of actually earnings. And again in 2020 and now more recently. So we've actually been in a profit decline since July of 2022, and earnings growth actually peaked in December of 2021. So quality stocks. So quality stocks refer to stocks that exhibit positive fundamentals. They typically have a high return on equity, stable year-over-year earnings, and also low financial leverage. Quality tends to outperform during difficult markets, especially during slowdowns and cyclical recessions. So some examples would be Home Depot, Microsoft, Apple, MasterCard. Looking at the S&P versus a quality stock basket. And you can see year to date that the S&P has underperformed the quality basket. We would think that if the environment continues to be challenging going forward, that these quality stocks, because of their low debt on their balance sheet, would continue to produce better actual earnings per share and result in better stock market returns going forward. Thank you for joining us for 3 and 3.